Welcome to ShortView Trading. This is your morning market hit for Friday, 3rd of April. What matters today for traders? Well, compared to recent weeks, it's actually been reasonably calm in the US equity market and indeed globally. The S&P 500 and the Nasdaq have both been rather range bound, albeit it's a broad range. The S&P's been trading between 2400 and 2640. The Nasdaq's been trading between 7365 and 79.95. Those ranges are largely encapsulated by two key Fibonacci ratios. Resistance has been the 38.2% Fibonacci retracement ratio. That is the retracement of all the losses from the highs to the lows on 23rd of March. Support has been the 23.6% Fibonacci ratio. You can see those in the charts we're putting in front of you now. So in a sense, it's been much calmer. And yesterday, both those indices bounced from near the bottom end of those ranges. And that calmness is evident in a couple of other pieces of information. In particular, if you look at the VIX, the candlestick chart that we're showing you now, you can see that it's come down sharply from its highs over the last couple of weeks. Equally, if you look at credit markets, there's been a lot of evidence of narrowing of spreads over a recent week or two. Whether you look at US high yield spreads, investment grade spreads, muni spreads, or even LIBOR OIS spreads in the last few trading sessions. So on the surface, things appear calmer, but under the surface, it's not so clear. Indeed, if you look at volumes that have been traded in recent days, they've come down sharply. Yes, they were very high as the market was crashing, but in normal capitulation, they're high in the relief rally as well. And indeed, the evidence of the last 5, 7, 8, 9 trading sessions is of much lower volumes and therefore lower conviction. Added to that, the typical price pattern in crashes involves a retest after the Wave 2 relief rally. The pattern is Wave 1 panic selling, Wave 2 relief, Wave 3 demoralisation selling, back to or even below the lows in Wave 1. As articulated in recent videos, the typical Wave 2 relief rally is 5 to 8 trading sessions with 9 to 21% gains on the S&P 500. Added to that, the message of our models is also quite clear. Short-term models have been back on sell or strong sell in recent trading sessions. You can see that now with the technical scoring system we're putting up in front of you, or indeed the risk appetite models that have been rolling over the last couple of days. Added to which, the breadth of stocks that have been advancing has been narrower in recent trading sessions. And you can see that looking at the percentage of stocks above their 10-day moving average chart that we're putting in front of you now, and that you can see it's been rolling over. So in the near term, we're getting nervous and shorts look increasingly interesting, and putting them on into strength is advisable. For the full detail of our 1 to 2 week views on equity markets, please see today's Daily Rag, available to subscribers and on the website. So what are we watching today? Well, as per recent days, signs of thawing or not in the credit markets. Anything further from policymakers over the course of today's trading session and indeed the weekend. The price action in relation to that range that we've been talking about and the possible Wave 3 demoralisation retest. And then in terms of macro, as we've been saying over the course of this week, it's starting to get interesting. Jobless claims yesterday spiked aggressively. Today we have non-farm payrolls, 1:30 London time. Over and above that, we have ISM non-manufacturing. All of this data is starting to build up a March picture for how the economy is playing out in the West. So that's it from us. That's your morning market hit for Friday the 3rd of April. Thank you for listening. Please do subscribe on YouTube, LinkedIn, Facebook and or Twitter. Thank you.